Welcome to my channel, everyone. In this video, we're going to talk about a volatility strategy that I use and some rules that I've established in order to adapt in different volatile market environments. And this is going to result in both better trades along with a better emotional experience in your whole trading journey as a whole. So if you're new here, before we do begin, all I could ask is if you make sure to hit that subscribe button. And if you want a very good trading resource, I'm going to link my Instagram in the description below. I post daily trading recaps and very good trading tips and tricks on here. You're definitely missing out if you aren't following it. Link is in the description below. Without further ado, let's get right into it. Something that every trader has to understand is market context. What I mean by this is that yesterday isn't the same as today, and today's action isn't going to be the same as what we're going to see tomorrow. Every day is going to be different. This is the analogy I always look at it as. The market is the storyteller. And for us traders to be profitable, we have to open that book and we have to comprehend what the storyteller is trying to tell us. It leaves context clues all day long, all night long, and we have to comprehend and understand what it's telling us. It's giving us these clues, and our clues are price and volume. They are the most leading indicators. If you look at, any other moving averages, oscillators, I'm not going to talk bad about them. Personally, do not use them, but price and volume are the truest form of clues or the footprints that the market actually does leave behind. It's the truest form of context, and they take precedence over anything else for me. All you need, the successful traders that I've seen, all use only price and volume. They don't rely on anything else. Indicators are just another part of the story. It's like you telling a story to somebody else, and then that other person tells a story to somebody else. The stories might match up, but they're not going to be the truest form. Price and volume, is that truest form. So how does this relate to us? So volatility is going to influence price. What I mean by this is that volatility not only makes the market move faster and more aggressively, it also makes price trade in wider ranges. In volatile markets, the market will move in crazy price swings up and down, and that in result, shakes some traders out. So think about how many times that you've entered a position before and it was somewhat of calm before the storm. The market really wasn't moving. You saw a good setup. And then as soon as you get in, the market starts, increasing volume. Maybe it shakes you out of the trade. It starts to jump. And then a few seconds later, it reverses on you and you take a big loss. How many of you have done that? Or how many times were you in a trade, you sold a little too early for a small profit? You're in a position, it starts moving in your favor. You didn't really like the conditions, so you took profit, you protected yourself, in for a small gain. And then a few minutes later, the market made a crazy move and you would have made, you made 50 bucks on that trade, but if you held, you would have made 500 bucks. And you compare how much you could have made if you held for a greater move. This is going to affect your, not only the price swings, but those price swings are going to affect your emotions. So anything that affects your emotions are going to affect your trading decisions. Believe me when I tell you that crazy price swings that affect price is going to affect your emotions, and those emotions are going to affect your trading decisions. Whether it give you FOMO, whether it give you fear, whether it give you greed, those are all bad things to implement in your trading. So you have to understand volatility. You have to understand that with volatility comes some good, and it also comes some bad. It could be more bad if you aren't aware of the things that we're going to talk about. And another key to successful trading, and this is something that many traders do not understand, is that you have to be mindful of your risk tolerance and you have to be very aware of price volatility so it doesn't change on how you view the market and how you make certain trading decisions. And what I mean by this is that every trader is going to have a different risk tolerance because every single trader is going to have a different strategy. They're going to have different position sizes in each trade. Think about how many active participants there are in the market. You have thousands and thousands of participants with different strategies, different entry points, different risk aversion, different position sizes. There's so many different variables that really are all bunched into the market, and everybody thinks that it's the same for everybody. You have to trade the same as you did yesterday. You have to trade the same as you did, a week ago. That's why it's important to keep a journal and review of the different situations. A scalper in a balanced market is going to have to adjust and trade differently than a scalper in an imbalanced market. And a trend reversal trader, or someone that's looking to day trade, a couple point swings in an imbalanced volatile market, is going to trade differently than a trend reversal trader in a balanced unvolatile market. So there's so many different scenarios. You have to figure out what is the market telling you, what its context, and the type of position that you are looking to open. And because of this, every market participant, every market itself has to have a different set of rules for your position sizes, your stop losses, your entry signals, and things like that. Like I said, there's so many different variables. So if I'm going to pull up my ThinkorSwim here, this is an example of an imbalanced market, and this was actually today. So there's a couple of signs of what I look for and what I tell members to look for in imbalanced markets versus balanced. In the course, I explain the exact, telltale signs that give me my real good reason the first hour and a half of market open, which is going to tell me the type of market we are in. Obviously, this is an imbalanced market. As the market moved down, we had a nice selling order imbalance up here at a supply zone. But because we're moving in such a large, widespread range, this is almost a 100-point drop from low to high, about 90 or so points. So there's volatility here. You could tell, again, by different instruments, by different little telltale signs that we look for. But this is what an imbalanced market looks like. And actually, if I pull up SPY, let's not even look at ES. Yesterday was an imbalanced market as well. SPY moved up about 6 or so points. The day prior to that, somewhat of a balance in the first 4 or so hours of the market open. And then, this day, when was this? January 26th, on Tuesday, this is an example of a balanced market. So as you can tell, the conditions are a little different. We don't get crazy price swings. And somebody that's a scalper is going to have to trade a little differently on a day like that. Or even a trend day trader is going to have to trade a little differently where we get smaller price swings like that than someone like today, where we had a perfect rejection off of supply and a nice drop right into this demand imbalance. Again, every market, you have to have a different set of rules depending on its context. And not being able to realize these conditions is going to lead to very poor trading choices. And these poor trading choices are going to lead to distress in not only your trading results, but the thought process that's constantly going through your head. And you're going to get so much frustration in those losses if they keep building up. And that frustration in those losses are going to bleed into your future trades. Believe me, subconsciously, the things you do today are going to affect what you do sometime in the future. If you're still hanging around and you're learning something from this video, all I could ask is if you just take 2 seconds, pause it, and hit that like button down below for me. It will help spread this message to other traders in the community. Like I mentioned earlier, how many of you taken a trade, you stopped out for a loss, and then 5 or 10 minutes later, the stock started to reverse, and it would have been a nice, winning trade. Maybe if you didn't stop out, maybe you raised your stop, maybe you adjusted your position size, maybe you tweaked your entry signal to get you a better risk to reward. Whatever the case may be, that subconscious dialogue that's constantly rolling through your head is going to do something we call emotional volatility. And if you take these losses over and over, it may look as, frustration is causing the loss of discipline in your own trading decisions. But in reality, it's just a failure to adjust to market context that's creating that frustration in your losing trades. Again, different markets, different stocks, different sectors all have different volatility patterns and all have different pricing patterns. It's not a one size fits all. Someone trading the S&P 500, whether it be the future or the option in a very thick liquid market, is going to be different than someone that's looking to trade maybe cattle futures or corn futures. Or someone looking to trade Amazon's, stock is going to be different than someone trading a stock that has very illiquid options. So it's not a one size fits all. Everything is different. And because of this, everything has to be adjusted based to the context of the market. If you do not adjust your position sizes, your stop losses, your target area, and your entry points, depending on what you are trading, you are going to get very frustrated when things do not work out in your favor. So here's what I use. This is my strategy. This is exactly how I compensate and how I work around this. Volatile markets mean greater price movements. So again, this is an imbalanced market. Imbalanced usually means volatility. we have crazy, greater price movements than what we see in a consolidation balanced market where participants are agreeing on price. Imbalanced means we have one side of the market not agreeing on price. Therefore, we're going to have greater price movements, and we have to compensate as traders to adjust our profit targets further out. And because we have further out profit targets, we are going to have to trade with less size and a wider stop loss to adjust and compensate for volatility and those crazy price swings. If I'm trading in a volatile market, I'm not going with 100 contracts. I might go half or even a quarter, because I know with crazy price swings, 100 contracts, maybe in a lower volatility market, might make me the same amount of money with 25 contracts in a volatile market. So lower volatility, balanced markets, smaller price movements, closer profit targets, and you have to trade with more size and tighter stop loss to compensate the consolidation type of action. Now, if we go back to this imbalanced chart, if I go back to Tuesday, you could obviously tell less size or more size in this type of market, because we have to look to take profits, pretty fast, because we might, get a bounce, we might get false breakouts, whatever the case may be. So we could trade size and have a tighter stop loss area, because this isn't, rallying 100 points in a couple of seconds. In a volatile market, if we go with heavy size, let's say we take the trade long up here. Let's say we have no clue about supply. We don't understand the concept of supply and demand. We look to take the market long when it's breaking out up here. We go in with 100 SPY contracts. A couple of minutes later, this thing reverses. We're in such heavy size, we cannot afford to have a wider stop loss. Then we stop out, we take a big loss, and again, we get frustrated, and that frustration promotes volatility in our emotions, and those types of things are going to affect our future trading decisions. This is exactly what I mean by trading with less size with a wider stop loss on a volatile market. Again, this is SPY today, rejecting supply. So the idea here is we want to take the trade short inside of a supply or a sell imbalance. So you could take the equity short, or if you trade options, we can look to take puts, because obviously puts are a bearish position. So I'm going to copy just the 375 puts into this left chart over here. I'm going to make this a little bigger for you all to see. So what I mean by less size in a volatile market, my cursors are synced. So where I'm selecting on both charts are going to be synced up. So at the time we hit supply, SPY 373 puts were around 60 to 70 cents when we hit supply, depending when you entered. Now, let's just say you get in with 10 contracts. We're going to call 10 contracts small size. It's a $600 position. If we held from supply, we scaled some at demand, and we scaled more at the furthest demand target, we could have got from 60 cents down to $2 and let's just call it $2.40, all the way to a high of $5.20. So that's $600 would have turned into, I don't know, I'm just guesstimating here, $1.80, so about $1,800 there, and then another $4.80, so probably about $6,000, $5,000, just off the top of my head, from a $600 investment if we trade with 10 contracts. Now you could look at it, what if we go in with 100 contracts and we got an average of $4 on the contracts? Yeah, we could have made 40 grand off of it from 6,000, but if the stock did reverse on you, it would have been a much larger losing trade because of the volatility of the market if it did reverse on us. We always have to trade defensively, and we have to understand risk management. If a trade gets represented with poor risk management, we're going to take big losing trades. So you have to assure yourself that different situations, require different position sizes. Another scenario is, let's say we didn't short at supply, we waited for it to come down a little bit, and, we shorted, I don't know, let's say we shorted when it broke VWAP down here. So at this time, the contracts were at, $1.20. So now we're inputs at $1.20. Then the market starts coming up, about a dollar or so. And now we're in $1.20. These contracts are now at, 70 cents. And we're down, if we traded 100 contracts, now we're down $5,000. So more volatility means trade with less size. Now this is an example of lower volatility where the market's balanced, why it's crucial that you have tighter stop losses and it's acceptable to trade with a little more size just to compensate for not crazy price swings. You could afford little rallies against you or little sell-offs against you as well. So here we have a move from 385 on SPY all the way down to 383. So about a $2 drop in the first 2.5 hours of the market open. When we have an imbalanced market, we had almost a $2 drop in a 10-minute period. So big differences in price. If I go back here, so here are SPY puts again. These went from a low of $1.50 to a high of $2.40. So only 90 cents the whole day on these contracts, and SPY only moved $2. So you're gonna have to trade a little differently on days like this, especially if you're trading options, depending on the time of day, depending on the volatility, depending on a lot of different factors with the Greeks. So you have to just be aware of the volatility, understand your risk tolerance, make sure that these crazy price swings affect how you actually trade the market, and don't go into the market every day thinking it's going to be the same. You have to look at it as, let's say you're driving down a highway or a freeway, and you're going to drive differently on one that's wide open and no one's on the road compared to trading one that's, completely traffic jammed, you can't move. It's the same exact thing. You don't want to be trading fast markets identically the same as you would with slower markets. So don't let the market movement control you. Just actively adjust to the day trading's environment and the context the market's telling you. You have to monitor your mood and understand how it affects different decisions, and you want to examine if the changes in markets are going to affect your mood, and then you have to affect your strategy based off of that. Doesn't matter what strategy you use, everything is the same. It's universal. So I hope you did enjoy this video. If you did, drop a like. Follow me on Instagram. If you want to learn more and you went through my YouTube videos already, you can learn more in depth on the course on my website. The link to that will also be in the description below. If you're still sticking around, appreciate it, and I'll see you all at the next video.